Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Hey everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Podcast. This is Phil Wong. With me as always is Brad Price, and joining us again is Kim Nguyen. Hey Kim.
Hey guys.
How's it going?
Good. Surviving.
Right on, that's good.
Yeah.
Hey Kim. So last time we talked a little bit about hitting the capital barrier wall. Actually, before we get into that, let's talk about any new updates for mortgages this past month.
Yeah, so within the past month, Bank of Canada did have a meeting. So as predicted, they kept rates the same. So the big thing that I like to mention to my clients is that this is probably going to be expected for at least, I would say, the next few years or so. But again, like with the economy, you never know, expect the unexpected. But with the way that the recovery is happening so far, interest rates are probably going to stay pretty steady for the next little while. In terms of what we're seeing, like lots of activity, definitely. So I'm seeing, there's a lot of refinances that I'm working on, a lot of purchases that I'm working on. And the banks are seeing this and they are ramping up their promotions, right? Of course, usually promos come in the spring market, but I have a funny feeling that it might be released a little bit earlier just to kind of capture the hot activity that's been happening so far.
Okay. And I mean, there's been a lot of talk about, rates going up sooner than expected recently in the news. What is your opinion on that? Any validity to that news?
Honestly, I say take it with a grain of salt, right? Because I mean, with the way that COVID is shaping our world right now, that plays a huge factor in things. And I would say rates rising is only ideal when we're in an economy that's fully recovered or on the way to recovery. But because there's so much unknown still, new variants coming up, maybe vaccine shortages, really it's so unpredictable. So that's why, hearing the headlines of all of that, I say take it with a grain of salt. We still have a long hill to climb, essentially.
Okay. Yeah. Okay, so nothing to worry about there then.
Nothing to worry about, yes.
Okay, awesome.
So like Phil mentioned, we in our last episode, we were talking a little bit about the capital barrier. Look, it's pretty unavoidable. If you're a real estate investor and you're starting to acquire a few properties, you're going to likely get there eventually. So, I mean, what is the strategy? How do people work around it as best as possible, Kim, or take as long as possible before they get to that capital barrier and are unable to get a mortgage with a big bank?
I find like the number one mistake that most investors do is when you're starting your journey, the first step is everyone knows to get a pre-approval. And if you don't know any brokers, most clients will go direct to their bank. And that's mistake number one, because again, depending on the bank that you are dealing with, every bank has different policies. And if you go direct to your bank, the person that you're dealing with will only know one set of policies. They'll only know that the bank that they're working for is policy, right? Whereas when you're working with a broker, with a holistic approach broker, their goal is to find out, well, what are your total, how many homes do you actually want to own? Like, what are your actual goals? If the objective is to own 10 or more properties or 10 or more doors, then we need to strategically place you with the proper lenders at each certain stage. But if let's say your goal was to only obtain maybe a few properties, like maybe under 5, then at that point, like it's really irrelevant where you go, because most lenders, a majority of lenders in Canada, will finance up to 5 rental properties for you pretty easy, right? Without any questions. But usually when we get above that, that's when it becomes a little bit complicated. But going back to the note, it's just the biggest thing I find is going to your bank. That is the one thing that I would definitely not recommend.
Yeah, no, fair enough. And it's good to know that, obviously brokers have, they're able to kind of strategize with you before you go and sign up for a mortgage, basically. So in regards to the 5 properties you mentioned, is that 5 properties in total, or is that 5 properties under that one bank's umbrella? Like how do those numbers actually really work?
Usually it's 5 properties in total. So that means if you own like a primary residence, that counts as a property, right? That's under. And again, if you own like an investment property, maybe like a second home that you have, a vacation home, that also counts as a property as well too.
Okay. And so aside from big banks, then, are there other sources of financing aside from private lenders that where you can get financing for your investment properties at a reasonable rate?
Definitely. There's, when we're looking into the financing world, you can get financing through banks, which is the most common. Everyone knows about the big banks out there. You see them everywhere. There's also monoline lenders, which many may not be familiar with. And monoline lenders they're still regular lenders. So don't think that they're like loan sharks or anything like that. They're still traditional lenders. They only deal with mortgages, hence why you won't see like a stand-up shop from them, right? They're able to give competitive pricing too, because again, they only deal with mortgages. They're online based. Doesn't mean that you're not going to get the same service that you would at a bank. They still do operate online through the phone. Everything is still, accessible with them. And again, like interest rates can be comparable and sometimes even better. Then we move into credit unions as well too. Like they could be another good potential partner too. The thing with credit unions that I like about them is if you're an investor looking at buying into a local area, maybe a smaller town, most of the time traditionally it's a little bit tricky to get financing on smaller urban cities, just simply because most banks, they like to lend in the bigger areas, right? The Calgary, the Edmonton, if we're talking like Alberta. But if you're looking to buy a property out in like, let's say Standard, something like that, small town, credit unions are your best friend because they understand the market.
Yeah, I think it's important what Kim just said there, because even knowing the Lethbridge market fairly well, Lethbridge is actually the 3rd largest city in Alberta now, just recently. But
Oh, the more you know.
yeah, absolutely. But even that, it doesn't seem to be enough to actually. I don't know what the right terminology is. So let's just go with educate the lenders that may be working in an office out in Eastern Canada, out in Toronto somewhere. Yeah, they're not familiar with these places like Lethbridge, and Lethbridge is the 3rd largest city in Alberta. So even then, it can be difficult to elaborate further for them as to that the cash flow potential of a property in Lethbridge.
Yeah, I mean, 3rd largest, but doesn't say a whole lot when there's a $900,000 population gap between the next largest city after that. Before that.
True. Hey, but you guys would be surprised, even a place more well-known like Red Deer, like, sometimes we still have struggles with them as well too, right? There's a lot of, going back to that note too. So we have bank lenders, we've got credit unions, we talked about monoline lenders. Then we also have alternative lenders too. So there's still banks per se, but their lending guidelines are a little bit more fluid, a little bit more flexible compared to the banks. But of course, you are paying a little bit of a rate premium. But even with them, right, they'll do a lot of out-of-the-box underwriting and financing. But with them, they'll only lend in major areas. So like sometimes like the Red Deer and the Lethbridge deal, sometimes it doesn't fit in that bucket.
Okay.
So one thing that you just said there, Kim, was about the rates. And this is one of the things I hear quite often just chatting with, especially new investors. They talk a lot about the really low interest rate, like the lowest possible interest rate. And I just simply ask them about the product, what sort of product is it, so what's the difference between getting the best interest rate versus getting the best product? And what does that actually mean?
I think again, it goes back to your goals again. If your goal essentially is to grow to, I use 10 rental properties, 10 doors, because that's such a common goal for many investors that I find. If let's say, a lender is going to give you the lowest rates possible, but again, they're going to cap you out at 5 properties. And then when you're buying your 6th property, no other lender will look at you because you did this, you did your financing in the wrong way. it may not be worth it for you at that point then. So I'll give you, I like to give this example where there's this red bank. So there's multiple red banks here. So this one red bank is notorious for their policy where they will finance 4 rental properties for you, okay, under their label. And they don't care how many rental properties you have in the portfolio. So you could have 20 rental properties, but they will still finance 4 for you. But if you were to go to this bank right away and you were a brand new investor, you had no rental properties at all, if you went and you kept buying your rental properties, you'd go up to 4 with them. And on your 5th, they'd say, hey, sorry, customer, I can't give you any more mortgages. You need to go find another bank. So if you go around to any other bank, most banks, their limit is at 5. So really, they would finance 1 more for you. But then after that, you're kind of hooped. So you're kind of stuck at that point. And really, to get your 6th door, the only other lenders that would lend to you would be alternative lenders, which means A, higher interest rates, and B, sometimes there's fees associated. So that's why it's a chess game. You have to be very strategic. If you want to grow into a large portfolio, you have to be strategic with who you use. But if, let's say, you only wanted a few rental properties, then who cares at that point? You know what? Go towards the interest rates if you want to. But one other struggle that I like to point out too is remember that when you're buying rental properties, minimum down payment is 20%. So as you buy rental properties, that money diminishes. So how can you regain that capital again? And that's when we could even look further by utilizing different products like a home equity line of credit.
Yeah, and that's exactly where I was going with the comment. You know, when we talk about it and we use the terminology product, that's exactly what we mean. Is how does the product fit with what you're trying to achieve, and how flexible is it to enable you to access capital, sooner rather than later, so you can continue your acquisition phase, or
Exactly.
implement your acquisition strategy to get the number of properties that you want to acquire. And if you're locking in a long-term mortgage that is just a standard fixed term mortgage with no options to set up a HELOC or access the equity without some hefty penalties, that's not flexible, and that doesn't allow you to utilize capital to go buy another house.
Mm-hmm.
Unless you're a really good saver, then maybe, right? But saving up 20%, as everyone knows, like that's a challenge, right? It is very tricky. It's doable, but it is a big, big goal for sure.
Mm-hmm. And you're really sacrificing one of the biggest advantages of real estate, which is leverage.
Exactly.
Right. A couple questions for you, Kim, actually. Can you access monolines by yourself? Is this something you can access as an individual looking for a mortgage?
No, actually, you cannot. So with monoline lenders, so those are the mortgage only lenders, they are only accessible through a broker. So you actually have to talk to a broker. Same thing with alternative lenders too. So those two are the ones where it is only available in the broker channel.
Okay. So I guess what is the best way if you say you wanted to grow to 10 properties, and say banks a lot of times do cap you at 5, but you want to grow to that 10 while still maintaining an ability to finance your properties? What pathway, I guess, would be most ideal for you to access in order to, delay hitting that financing wall, that capital wall?
So I always recommend HELOCs, right? Home equity lines of credit, because if you want to grow to the 10 doors, the first problem is cash flow. So that's why within the first couple properties, it's good to set it up as a home equity line of credit. So then that way, as you pay down your mortgage, you have that equity. And the way I like to describe it is, as you're paying it down, you take that equity and essentially that will become your 20% that you can use to buy another property, so on and so forth. So in the beginning stages, you have to make sure you can set something up along those lines. But at the same time, too, you got to be strategic with what banks to use at that point. Now, home equity lines of credit are primarily offered through banks, but there are some monolines that do offer it as well, too. So don't completely rule them out, but it's just, the path of, okay, well, which lender should I pick? right? And that's where a specialist would be able to jump in and chime in and be like, no, we need to go to bank A first for the first 5 or first 3 or whatever the case is, because they've got the best HELOC, and the rates are very competitive. And then for properties 4, 5, 6, 7, then we go to this bank, and so on and so forth.
Okay. I guess another way to ask my question too is like what I'm trying to say is it better to hit up the smaller lenders first before you hit the big banks?
It depends, because
Okay.
like I say, it depends, because one thing you have to remember too is policies do change, right?
Hmm.
So what we're talking about right now could change in a year from now or a few months from now. You just
Mhm.
never know. But I always say there's a lot of things to consider, because there was a point in time where with rental properties there was no premiums attached, and this was only available on the bank side. So if you were to get a rental property, in today's world right now, let's say the interest rate is 1.64. I'll use that as an example. If you're buying a rental property, that rate will jack up another 10, 15 basis points, right? Maybe 174 or 1.89, something around that realm. But once upon a time, banks didn't have any type of those premiums, whereas the smaller lenders, the monoline lenders, they did have that, right? So it just depends again.
Okay.
So yeah, that's interesting, because I get asked occasionally about, hey, what do you think of this interest rate that I just got offered on this rental property? And yeah, it's the same answer. It's like, well, they know that it's an investment property. In turn, you're making money and they want to make money. So it's not going to be the same rate as your principal residence, right? In most cases. Hey,
Well, to speak on that too, like one thing I like to bring to light is most people think that it's just because it's an investment property, it has to be more expensive. But there is logic behind it, and the logic behind it is that most lenders, they feel that if it's a home that you're planning to reside in, like a primary residence, you take good care of your home, right? You're not gonna, you're gonna take good care of it. Like you're not just gonna smash into the walls or whatnot. Whereas an investment property, there's still that stigma along most lenders that, you know what, your tenants aren't going to care. They're going to nick the walls. And when they carry groceries in, like if it smashes the door or something, they don't care, right? It's a rental property. It's not their own home. So that's kind of where the additional risk comes in for them too.
Okay.
yeah, plus that risk element of non-payment as well.
Yeah.
When you look at a principal residence versus a rental property, I mean, if you have both, you're more likely to stop paying the rental property mortgage before you stop paying your principal residence, because you need somewhere to live.
Yeah.
So Kim, are you able to explain to people what the collateral mortgages are? What do they mean? Like I feel as though not many people really understand when they're getting started. They don't understand what a collateral mortgage is. And, back before I started, I didn't fully understand what it was either. And I remember a piece of paper got put in front of me and said, "Oh yeah, here you should do this," with no explanation or anything. And I just thought to myself, I need time to work through what this
Like, what
means.
is
And
this?
yeah, exactly. Now I know. I think to myself, I should have set that up a little bit differently. But I didn't realize I had those options at the time, and I was new. I was fresh out of the gate. So I mean, even nowadays, when you're talking to people or you're talking to a broker, I find that I'm like, hey, this is how I would like to structure this. You get to that point where you know what you want, how you want to set it up, and yeah, you still strategize, you still have that conversation, but having that understanding, it enables you to kind of, be direct with how you would like to set up your accounts. So can you explain what the collateral mortgages
Yeah,
are?
sure. So with a collateral charge mortgage, this is again not available through all lenders. So something to keep in mind. So when you get a mortgage, there's two types of charges. Either we get a traditional conventional charge or a collateral charge. Now, a conventional charge just means if let's say you're getting a mortgage for 400,000, the charge on the land titles would just be for 400,000. Okay, that would just be the standard charge. On the collateral charge side, you are allowed to register up to 125% of the value of the home. So even though your mortgage is 400,000, if you wanted, you could place the collateral charge higher. So let's say you place it for 500,000. I'll just use that as an example. You can place it higher. So then that way, what happens is down the line, if ever your property increases in value, you can always refinance your mortgage and you can go up to a total mortgage of 500,000 and not pay any legal registration fees. That is one of the main benefits of the collateral charge mortgage. Now, there's also some cons to it as well too. Like there's just going back again to the whole charge. If you put the charge at 500,000 doesn't mean that you're going to get the 500,000. Just keep in mind, it does depend on the appraised value too. Like you'd have to do a full appraisal because banks will only lend you 80% of the appraised value. But essentially, it's a great tool, especially for investors that know, hey, listen, in the next few years or so, this property is going to appreciate and I want to take that money out because then I can use that money to further invest, so on and so forth. And I save myself the legal fees because usually if you had a conventional charge mortgage, that means that any time that you need to make any changes, let's say you need to do a refinance, you'd have to repay the legal fees, which is, again, depending on the lender, depending on the bank, the lawyers and stuff, it could be quite costly.
And would you have to go through a full application if you already have that registered amount?
You would, yeah, full application. So still got to make sure that you qualify for it.
Yeah. Okay. So it's really to mitigate the legal fees and give you an avenue to simplify the process somewhat.
Exactly. But I will touch base on the cons too, because again, not many people talk about that. The con to having like a higher collateral charge is, should you be in a position where, let's say you need a private loan, like a second position private loan, because you registered the value, like the collateral charge so high. Most second position loans or private lenders, they will not go in second if that collateral charge is too high, right? They'll base even though you owe 400,000, they'll treat it as if you owe 500,000.
Okay, so they're afraid that they may not get paid because of the collateral charge being so high.
Exactly.
Okay.
That's good to know. That's good to know, because if you are planning on doing any secondary financing or setting up some form of second or third place mortgage or private loans against that property that you own that you've set up there, then they may not that may not be executed based on those numbers.
Exactly.
Mhm. I guess, I mean, let's talk about the inevitable here, because eventually you'll hit the financing wall no matter what, right? Especially if you're going to keep growing, some sooner than others, depending on which avenue you take and which banks you go with. So what are some tactics once you get to that point where banks, monolines, credit unions don't lend to you anymore? What options do you have at that point?
At that point, again, depending on the amount of properties that you have and also the total loans outstanding, one exit strategy that we see is converting your entire portfolio into a commercial portfolio. So what that essentially does is you're moving everything that's under your personal name into a holding company that you still own. So just remember, like I said, it's still your property. You're not selling it to somebody. What we're doing now is we're getting a commercial blanket loan, which moves all of the mortgages from your personal name into your company name. So while you still own the properties itself, it's just in another entity. But what happens is it's completely erased from your personal credit bureau. So to a lender, it looks like you own nothing. So here we go. We start to build again.
Okay. I guess aside from cost then of doing that, what are some potential cons of that strategy, if any?
Yeah, I would say, yes, cost is one, interest rate as well too, because keep in mind, commercial interest rates are completely different than residential. And one thing that you have to be mindful of is if, let's say you have 10 rental properties already, when we're looking at doing the consolidation, you also have to line up your maturity dates as well too, because if you've got a few properties that don't mature until another few more years, your penalty is going to be super, super high to bring over. That's why, when you're nearing that end point and you're kind of sensing the hesitation from lenders that they're like, oh, this is your last home that we're giving you. That's when, when properties come up for renewal, try to align it at the same time. So that way you can swiftly execute it all in one shot.
Okay.
So when we talk about penalties, Kim, I mean, there's penalty calculators online, and it's probably the quickest and easiest way to work out what your penalty roughly is going to be. The best way is actually call the bank and ask them. But what, like, is there any difference between lenders and their penalties and the products that you can acquire?
Always. There's so much differences between all the lenders when it comes to a bank penalty. So we'll break it down with fixed rate versus variable rates. If you're in a fixed rate mortgage, your penalty generally is always higher. So your penalty will always be it will either be interest rate differential or 3 months interest, whichever is greater. But most of the time, it's always interest rate differential. If you're in a variable rate mortgage, your penalty will always be 3 months interest only. So in that case there, it's an easier pill to swallow. But when we're looking at fixed rates and the interest rate differential, it's different from banks versus monolines. So monolines being the lenders that they only deal with mortgages. With the way that the banks calculate it, it's actually a higher penalty compared to the monolines, because monolines, they compare rate for rate, dollar for dollar. So if the rate that you got with them is, let's say, 2%, and the current rates now are 1.78, whatever that difference is, that is your penalty. But where the banks calculate it is they take a look at what discount that they gave you off of posted rates, so a little bit more complex. And again, usually, like pretty much 9 times out of 10, their penalty is much higher.
So are they adding that, or are they disregarding that discount that they gave you initially, and they're going with the
current discount?
Yeah. Right, I see.
Yeah. So that's why, again, you have to be really careful when it comes to these penalties. If you know, like as an investor, you're, maybe doing some changes, just go with the variable, right? It'll help you sleep at night, because again, your penalty is only 3 months interest, especially if you're hitting that wall, you're getting very, very close. Just do the variable rate.
Okay.
Good
to know. And I guess last ditch effort, and aside from going towards a commercial mortgage, would be to find other people who can qualify for you.
Exactly. Yeah, you can look at that. Or another thing too is that always remember, alternative lenders are your friend. They are there because really, in essence, in a perfect world, you could actually build your portfolio easily to 20 doors, right? But you do have to utilize the alternative lenders. Now, alternative lenders, the thing is, their qualifying is pretty much on par with the banks, sometimes even easier. Sometimes they do give a lot more exceptions, right? If your ratios are a little bit extended or a little bit higher, you know what? If you've got like great credit, they may just give that exception for you to proceed. But the only thing with that is the interest rate is higher. So you have to make sure that at the end of the day, with this higher interest rate, and usually it's in the range of 3.5 to about 4.5 is the range right now. If your property still cash flows, given that interest rate, it's a go, right? I think personally, because it's going to be, like I said, it's either you move everything to commercial, or you start staggering the alternative lenders. And
do they utilize net worth? I mean, does that come into it at any point in time?
It does. Yes, it does. It can. So net worth in what context? Like, are you just asking, like, if you have savings, they'll just kind of lend to you dollar for dollar, or?
What I mean by that is, so eventually when you get further down the road and you have a large portfolio per se, and you've got a large portion of that is equity, and it's also generating a high dollar value in gross revenue, so rental income every year. But maybe you're not working. Maybe you're not working. You're living off your portfolio. That's your lifestyle. I mean, how do I have a feeling I know how the big banks view that, but how do the smaller
they're actually okay with it, believe it or not. So there's a very rare few that are okay with that. But the biggest thing is that they need to see that income declared on your T1 general. So again, going back to the taxation thing, everything has to be, declared on there. And the biggest thing is they're going to be scrutinizing all of your expenses as well too. So if, let's say, you did a bunch of renovations to one property, and if the lender that we're going to right now wants to see your 2019 taxes, because that's the current year that we have so far. If that one year had that massive renovations amount, and even though you can say, no, like in the present moment, like, look, like this is my cash flow, it's very, very strong, they won't be able to proceed, right? It has to be on declared income.
Okay.
I think that's a really important conversation piece, because I mean, as real estate investors, we're all trying or working towards that point of financial freedom, whereby our real estate is generating our income and we can spend more time doing what we want to do and spending time with family. But I also think it's important to understand that there's still options out there if opportunities arise.
Exactly. Yep.
You know, because we still like to do real estate and acquire properties and do bits and pieces here and there. So it's really good to know that those options are available.
But like I said, you know, it does come with a higher rate, and I know some investors get afraid of that. But again, like if the investment works out with a higher interest rate too, it's a win-win all around.
Yeah, absolutely. I mean, it really just puts the emphasis on finding high cash flow opportunities at that point.
Yep.
You know, or like I said, if you can JV with someone who can qualify, I think that might be a better option too, if you still want that low cash flow rate while giving up some of your equity too, right? So
Exactly. Yeah. Lots of
that's
different
also, also an option. But
Yeah.
Awesome.
yeah.
Well, I mean, this has been really eye-opening, you know, in terms of how to stretch out that period of time before you hit that capital barrier, and then what to do once you actually get there. So,
So I feel the bottom line for this is don't go straight to your big banks right away. You know, go to a broker, see what they can do for you first before you jump in with the big banks, because that might cap you out a bit earlier than you otherwise might be able to. Yeah, you might be able to extend your portfolio a lot further than you think. So, well, thank you, Kim, for all the good info today.
My pleasure. Thanks, guys.
thanks again, Kim.
I'll catch you next time. Hey, everyone. Thanks for listening. Just a couple items before we head off. We wanted to let everyone know that we're starting our monthly live events again. It's a great place to connect with other real estate investors and to learn from our various guest speakers. They will be hosted on the last Tuesday of every month, and to sign up or find out more, please visit the events page at cwho.ca. I'll see you guys next time.
Thank you for listening to the Commonwealth Home Ownership Podcast. Be sure to check out all of our past episodes and our ever-growing library of content at cwho.ca. Until next time, remember to get out there, take action, and create a life of wealth by design.